Imagine this. You retire after 40 years of hard work. You finally have time to relax, time to travel, time to enjoy your life. And then, 6 months later, you receive a letter from the IRS. Your heart starts racing as you open it. The letter says you owe $400 in penalties. Penalties for something called failure to take required minimum distributions. You have no idea what that means. You never got a warning. You never got a reminder. And now the IRS is demanding payment with interest. You look at the letter again. Your hands are shaking. You did everything right. You saved your entire life. You followed the rules at work. You paid your taxes every year. So how is this possible? How could you owe thousands of dollars in penalties for something you never even knew you had to do? This is not a nightmare. This is happening to thousands of retirees across America right now. And it could happen to you if you do not know the 10 things the IRS expects you to do the moment you retire. Hello and welcome. My name is Milena. I'm a senior policy analyst and retirement finance expert, and I have spent years helping retirees just like you navigate the complicated rules that govern your Social Security, your pension, your IRA, and your taxes. Every single week, I hear from seniors who are confused, scared, and overwhelmed by IRS letters they do not understand. And today, I want to make sure that never happens to you. In this video, I'm going to walk you through 10 specific things the IRS expects you to do when you retire. These are not optional. These are not suggestions. These are federal requirements. And if you miss even one of them, you could face penalties, interest charges, and massive unexpected tax bills. But here's the good news. Every single one of these requirements is completely manageable if you know what to do. And I am going to show you exactly what to do, step by step, in plain language, using only official government sources. But I need you to do one thing for me. Stay until the very end of this video. Because near the end, I am going to reveal the single most dangerous mistake retirees make in their first year of retirement. A mistake that can cost you tens of thousands of dollars in unnecessary taxes. And most people have no idea they are making it. Are you ready? Let's begin. I want to tell you about a man named Robert. Robert is 73 years old. He lives in Pennsylvania. He worked for 42 years as an electrical engineer. He was careful with his money. He contributed to his 401k every single paycheck. He built up a retirement account worth about $480,000. He also had a small pension from his company, and he had been receiving Social Security since age 67. Robert retired in March of 2024. His company gave him a retirement party. His co-workers wished him well, and Robert went home feeling proud of what he had accomplished, proud of the nest egg he had built. He felt secure, but Robert made one critical mistake that would cost him dearly. When Robert retired, nobody told him about required minimum distributions. Nobody told him that once he turned 73, the IRS required him to withdraw a specific amount from his IRA every single year. Robert assumed his money could just sit there, growing, waiting for him to use it when he needed it. That is what he had been told for years. Let your retirement account grow. So that is exactly what Robert did. He left the money alone. He lived off his pension and Social Security. And he did not touch his IRA. Months went by. Robert was happy. Retired life was good. And then, in February of 2025, Robert received a letter from the IRS. The letter said he had failed to take his required minimum distribution for 2024. The amount he was supposed to withdraw was $1,700. And because he did not take it, the IRS was imposing a penalty. The penalty was 25% of the amount he should have withdrawn. That is $4,300. Robert was stunned. He had no idea this rule even existed. He immediately called his financial advisor. The advisor confirmed it. Yes, Robert was required to take the distribution. Yes, the penalty was real. And yes, Robert still had to withdraw the $1,200 and pay taxes on it, on top of the penalty. Robert felt sick. He had done everything right his entire life. He had saved carefully. He had paid his taxes on time. He had never been in trouble with the IRS. And now, because of one rule he did not know about, he owed nearly $5,000 in penalties. Robert's story is not unique. In fact, it is heartbreakingly common. And I am telling you this today, not to scare you, but to make absolutely sure you never find yourself in Robert's situation. Because the truth is, Robert could have avoided this completely. If he had known the rule, if he had taken action in time, if someone had simply explained to him what the IRS expected. So let me do that for you right now. Let us start with the foundation. The IRS has very specific expectations when you retire, and most of them are never clearly explained to retirees. So I am going to break them down for you, one by one. using only official IRS and Social Security Administration sources. Here are the 10 things the IRS expects you to do the moment you retire. Requirement number 1. You must start taking required minimum distributions from your IRA at age 73. This is the rule that caught Robert. According to the IRS, you generally have to start taking withdrawals from your IRA, simple IRA, SIP IRA, or retirement plan account when you reach age 73. These withdrawals are called required minimum distributions, or RMDs. You must take your RMD by December 31st every year. But here's where it gets tricky. For your first RMD, the year you turn 73, you have a choice. You can take it by December 31st of that year, or you can wait until April 1st of the following year. But if you wait until April 1st, you will have to take 2 distributions in 1 calendar year, your first RMD and your second RMD. That means double the taxable income in 1 year. And that can push you into a higher tax bracket. So my advice, take your first RMD by December 31 of the year you turn 73. Spread the tax burden over 2 years instead of 1. And one more thing. This rule does not apply to Roth IRAs while you are alive. Roth IRAs do not have required minimum distributions. Only traditional IRAs, SEP IRAs, simple IRAs, and 401k accounts. This is one of the biggest surprises for retirees. During your working years, your employer automatically withheld taxes from your paycheck. You did not have to think about it, but in retirement, tax withholding does not happen automatically. You have to request it. If you do not submit a form called Form W4P to your pension administrator, they will withhold taxes as if you are single with no adjustments. That might be way too much or way too little. For IRA distributions, the default withholding rate is 10%. But for many retirees, 10% is not nearly enough. If you are in the 22% tax bracket and only 10% is being withheld, you will owe a big tax bill in April. So here is what you need to do. Contact your pension administrator. Contact your IRA custodian. Ask them for Form W4P or Form W4R. Fill it out. Choose the withholding percentage that matches your actual tax bracket and submit it. Do not assume it will happen automatically. It will not. Here is something that shocks most retirees. About 40% of people who receive Social Security have to pay federal income taxes on their benefits. This happens if you have other substantial income, like a pension, IRA withdrawals, or investment income. The IRS uses something called combined income to determine if your Social Security is taxable. Combined income is your adjusted gross income, plus any tax-exempt interest, plus 1/2 of your Social Security benefits. If your combined income as a single filer is more than $25,000, up to 50% of your Social Security may be taxable. If it is more than $34,000, up to 85% may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Now here is the problem. The Social Security Administration does not automatically withhold taxes. You have to request it. You can ask them to withhold 7%, 10%, 12%, or 22% of your monthly payment. To do this, you can fill out Form W4V, Voluntary Withholding Request. You can submit it online through your My Social Security account, or you can mail it to your local Social Security office. If you do not do this and your Social Security ends up being taxable, you will owe the IRS a lump sum when you file your tax return. And that can be a very unpleasant surprise. Requirement number 4. You may be required to make quarterly estimated tax payments. This is a big one. The IRS operates on a pay-as-you-go system. That means you are supposed to pay taxes throughout the year, not all at once in April. When you were working, your employer handled this through paycheck withholding. But in retirement, if your withholding is not enough to cover your tax liability, you must make estimated tax payments every quarter. Here is the rule. You must make estimated tax payments if you expect to owe at least $1,000 in tax after subtracting your withholding and credits. And your withholding must cover at least 90% of your current year tax, or 100% of your prior year tax. If your income was over $150,000 last year, you need to pay 110% of your prior year tax. Estimated tax payments are due 4 times a year: April 15th, June 15th, September 15th, and January 15th of the following year. If you miss these deadlines, the IRS will charge you underpayment penalties, even if you are due a refund when you file your tax return. So if you have investment income, rental income, or large IRA withdrawals, Talk to a tax professional. Figure out if you need to make estimated payments, and if you do, use Form 1040-ES to calculate the amount and make your payments on time. When you retire or change jobs, you may want to move money from your 401k to an IRA, or from one IRA to another. If you take the money as a distribution with the intention of depositing it into another retirement account later, you have exactly 60 days to complete the rollover. If you miss that 60-day deadline, the entire amount becomes a taxable distribution. And if you are under age 59 and a half, you will also owe a 10% early withdrawal penalty. But here is the even bigger trap. If you take the distribution as a check made out to you, the IRS requires your plan administrator to withhold 20% for taxes. So if you take a $50,000 distribution, you will only receive $40,000. To complete a full rollover, you must deposit the entire $50,000 into the new account within 60 days. That means you have to come up with the missing $10,000 out of your own pocket. If you only deposit the $40,000 you received, the $10,000 that was withheld is treated as a taxable distribution. So here is what you should do instead. Request a direct rollover. That means the money goes directly from your old retirement account to your new retirement account. You never touch it. No withholding, no 60-day deadline, no risk. Always choose the direct rollover option. Many retirees assume their pension is tax-free because they already paid into it for decades. That is not how it works. According to the IRS, your pension or annuity payments are fully taxable if you have no after-tax investment in the contract. What does that mean? It means if your employer made all the contributions and you never contributed any after-tax dollars, then your pension is 100% taxable. If you did contribute after-tax dollars, then part of your pension is tax-free, but you need to know which part. Your pension administrator should provide you with information about your cost basis, the amount you contributed after tax. That amount will not be taxed again, but everything else is taxable as ordinary income. Do not assume your pension is tax-free. Check with your pension administrator. Get the facts and plan your withholding accordingly. Requirement number 7. If you take money out of your IRA before age 59 and a half, you may owe a 10% early withdrawal penalty. If you retire early, before age 59 and a half, and you start taking money out of your IRA or 401k, you will generally owe a 10% penalty on top of ordinary income tax. So if you withdraw $30,000, you will owe income tax on that $30,000. Let us say 22%, which is $6,600, plus a 10% penalty, which is $3,000. That is a total tax bill of $9,600, nearly 1/3 of your withdrawal. But there are exceptions. If you become totally and permanently disabled, no penalty. If you set up substantially equal periodic payments after separation from service, no penalty. If you have been certified by a physician as terminally ill, no penalty. If you qualify for one of these exceptions, you can avoid the penalty, but you must file Form 5329 with your tax return to claim the exception. Do not just assume the IRS will know. You have to tell them. Requirement number 8. You must report all retirement distributions on your tax return. Every time you take money out of your IRA, 401k, or pension, you will receive a form called Form 1099-R. This form shows how much you withdrew and how much tax was withheld. You must report this on your tax return, even if you are over age 73 and taking required minimum distributions, even if the full amount was withheld for taxes. You still have to report it. And if you receive Social Security, you will get a Form SSA 1099. That also must be reported. Do not ignore these forms. Do not assume the IRS already knows and you do not have to report it. You do. Every distribution must be reported on Form 1040 or Form 1040-SR. Requirement number 9. You must meet the quarterly estimated tax deadlines. I mentioned this earlier, but it is so important I'm going to say it again. The year is divided into 4 payment periods for estimated taxes: April 15th, June 15th, September 15th, January 15th. If you owe estimated taxes and you miss one of these deadlines, the IRS will charge you a penalty for that quarter, even if you pay extra in the next quarter, even if you are due a refund when you file. The penalties are calculated separately for each period, so mark these dates on your calendar, set reminders, and pay on time. Requirement 10. You must keep your beneficiary designations up to date. This one does not affect your taxes directly, but it can have devastating consequences for your heirs. When you opened your IRA or 401k, you named a beneficiary. That beneficiary designation controls who gets the money when you die. It does not matter what your will says. The beneficiary designation overrides your will. If you got divorced and never updated your beneficiary form, your ex-spouse could inherit your entire IRA. If your spouse passed away and you never updated the form, the IRA may go to your estate instead of your children. And here's the tax consequence. Under current law, most non-spouse beneficiaries must empty an inherited IRA within 10 years. That is called the 10-year rule. It applies to IRAs inherited after December 31st, 2019. If your adult children inherit your IRA, they must withdraw the entire balance within 10 years. And every dollar they withdraw is taxable income. If they wait until year 10 and take it all at once, they could face a massive tax bill. So please review your beneficiary designations. Make sure they reflect your current wishes. And talk to your beneficiaries about the 10-year rule so they can plan accordingly. Those are the 10 things the IRS expects you to do when you retire. Let me summarize them quickly. 1. Start taking required minimum distributions at age 73. 2. Actively manage tax withholding on your pension and IRA. 3. Decide whether to withhold taxes from Social Security. 4. Make quarterly estimated tax payments if required. 5. Roll over retirement accounts within 60 days or use direct rollovers. 6. Understand whether your pension is taxable. 7. Know the early withdrawal penalty rules if you retire before 59 and a half. 8. Report all distributions on your tax return. 9. Meet quarterly estimated tax deadlines. 10. Keep your beneficiary designations up to date. Now let me give you 3 specific action steps you can take this week. Segment 5. The Action Plan. 3 steps. All right. Here is your 3-step action plan. These steps will protect you from IRS penalties, surprise tax bills, and costly mistakes. You can start today. Let's go. Step 1. If you are 73 or older, verify your required minimum distribution amount and deadline. Call your IRA custodian, the bank, brokerage, or financial institution that holds your IRA. Ask them, what is my required minimum distribution for this year? By law, they must either tell you the amount or offer to calculate it for you. They are required to send you this information by January 31st every year. If you have not received it, call them, get the exact amount, get the deadline, and take the distribution on time. If you have multiple IRAs, you can take the total RMD from one account or split it among them. But if you have a 401k or 403b, you must take the RMD separately from each account. Do not guess. Do not wait. Call today. Step 2. Request tax withholding forms from every source of retirement income. Make a list of every source of income you have in retirement: Social Security, pension, IRA distributions, 401k distributions. For each one, contact the payer and request the appropriate withholding form. For Social Security, request form W4V or adjust withholding through your My Social Security account online. For pensions and regular IRA payments, request form W4P. For one-time IRA or 401k distributions, request form W4R. Fill out these forms. Choose a withholding percentage that matches your tax bracket. If you are not sure what that is, talk to a tax professional, submit the forms, and keep copies for your records. This one step can save you from massive surprise tax bills in April. Step 3. Create an IRS online account and review your tax payment status quarterly. Go to irs.gov account, create your free IRS online account. Once you are logged in, you can see your current balance owed, all payments you have made, your estimated tax payments, your tax transcripts, payment plan options if you owe money. Check this account every quarter. Make sure your estimated payments are being credited. Make sure your withholding is on track. If you see a problem, fix it immediately. Do not wait until April. This account gives you real-time visibility into your tax situation, and it is free. Use it. Let me give you a quick summary. Step 1. Verify your RMD amount and deadline if you are 73 or older. Step 2. Request tax withholding forms from every source of retirement income and submit them. Step 3. Create an IRS online account and monitor your tax payments quarterly. Do these 3 things, and you will avoid the traps that catch thousands of retirees every single year. Segment 6. The Community Call to Action. Before I let you go today, I want to share something very important with you, something that goes beyond just this one video. The rules that govern your retirement, your IRA, your Social Security, your taxes, change constantly. The age for required minimum distributions just changed from 72 to 73. Tax brackets change, withholding rules change, Social Security rules change. And often, by the time most retirees hear about these changes, it is too late. They have already made the mistake. They have already missed the deadline. They have already triggered the penalty. YouTube notifications are helpful, but they are not enough. The algorithm does not always show you every video. A notification might not come through, and a critical rule change could happen, and you might not hear about it for months. That is why I want to personally invite you to join our global Senior Alerts official WhatsApp channel. This is not a group chat. You will not be bombarded with messages. It is a one-way official alerts channel where we send you real-time updates the moment important rules change for retirees. We cover Social Security payment changes, Medicare and insurance policy updates, IRS and pension tax rule changes, banking regulations that affect seniors, and TSA travel rules. And right now, when you join the channel, you will receive a free download. It is called the Senior Benefits Protection Guide. This guide includes everything we discussed today. The 10 IRS requirements at retirement, explained in simple language. A checklist of forms you need to request. The quarterly estimated tax deadlines. How to check your RMD. How to set up tax withholding. And how to avoid the most common, costly mistakes. This guide is yours, completely free, just for joining the channel. The link is in the description below this video. Click it now before you close this page, because I do not want you to forget. And if you found today's video helpful, please share it. Share it with your spouse. Share it with a friend who just retired. Share it with a neighbor who is worried about taxes. Because here is the truth. The information I shared with you today exists in IRS publications. It is on official government websites. It is publicly available. But nobody ever sits down with a retiree and explains it clearly, in plain language, with real examples and real action steps. That is what I am here to do. I am Milena, and my promise to you is simple. Every video I make will be based on verified facts from official government sources only. No rumors, no scare tactics, no exaggerations, just the truth I clearly explain, so you can make confident, informed decisions about your retirement. Thank you so much for watching today. Please click the link in the description to join the Global Senior Alerts official WhatsApp channel and download your free Senior Benefits Protection Guide. Subscribe to this channel if you have not already, and leave me a comment below. Tell me, did you know about all 10 of these IRS requirements before today? Or was this the first time you heard about some of them? I read every comment, and your feedback helps me know which topics to cover next. Take care of yourself, protect your retirement, and I will see you in the next video.